Hello, I'm Kristen King and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Today, we're taking a look at how a professional trader sets up a trade before earnings. And we'll be looking at a stock that, according to Trackstar IQ, our proprietary search tracking tool, is the most researched stock by Wall Street investors this month: Disney. 125 Wall Street investors researched the media giant over 1,294 times this month, and with earnings due on the 12th, the interest is understandable. Disney announced a major reorganization of its business on October 12th to prioritize Disney Plus and content streaming with immediate effect. How the market digests this in the long run remains to be seen, but the immediate price action saw a gap higher. The stock is close to a flat year to date and up 60% from the March lows, but the real question is, where does it go from here? Let's start with the bullish setup. The first thing to note is that $140 has been an active level over the past couple of years, so it's bullish to see the stock close above it ahead of earnings. Now, although technical analysis comes with a multitude of caveats, point and figure charts serve a solid risk management purpose and are much more widely used for long-term positioning than people realize. They monitor supply and demand while keeping an eye on developing trends and smooth out a lot of noise. So, looking at an hourly chart, we can see that there's been a triple top breakout on heavy volume, which is a bullish signal. Also, there is a bullish failed breach of the upward supporting trend line. Flipping back to a traditional chart again, we can see the gap lower in February has been filled, which is bullish, as is the gap fill in August. If good numbers come out tomorrow, traders will be looking to get long with a stop below $117 and an eye on breaking out above the all-time high at $153 per share. Now, let's take a look at reasons not to buy. While news of a COVID-19 vaccine caused an initial spike, it proved to be a dud rally. Even with optimism, the reality is that any rollout would be months away, and there is still a winter second wave to navigate first. Disney is putting its eggs in the digital basket as the company awaits a green light from health officials for Disneyland and Disney California Adventure to reopen. The company announced 28,000 layoffs from its parks, experiences, and product segment in late September because of protracted theme park closures caused by the coronavirus pandemic. Q4 earnings are out on November 12th, and analysts are expecting Disney to report a loss of 73 cents a share, down from net income of $1.07 a share a year ago. Analysts have also lowered their outlook for the quarter since the last earnings report, as theme parks in California remain shuttered and live action productions remain restricted. On average, Wall Street expects Disney to report $14.15 billion in fourth quarter revenue, down from $19.1 billion in the same quarter a year ago. That said, an earnings miss in August saw an initial move higher because market reactions are often based on relative perception as much as results. The reality facing Disney investors is that yes, this is a media giant with the size and influence to become a leader in the streaming vertical. But can it make a pivot instantaneously whilst up against an agile pack of competitors? Let's wait and see. In this scenario, traders might consider a stop above $153 with an initial target of closing the gap around $127. That's all we have time for today, folks. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. As always, make sure you do your own due diligence before making any investment decisions.